Hello and welcome to the Golden Thumb Rule, a podcast where we decode timeless investing principles with market experts to help you cut through the clutter and focus on what truly matters. Well, I'm your host, Kshitij Anand, and today we are diving into a very important theme, investing beyond the noise and timeless principles for building wealth. And to help us understand this better, we have with us a very special guest, Harsha Upadhyaya, our CIO at Kotak Mahindra Asset Management Company. Harsha has decades of experience navigating market cycles and building long-term wealth for investors. Welcome to the show, Harsha.
Thank you, Kshitij. It's a pleasure speaking to you.
Thank you so much for taking the time out. And it's always a pleasure to have you on the show, Harsha. And let's begin with the basics. In today's hyper-connected world, there's constant noise from, you could say, social media chatter to daily market movements. So for an average investor, it's overwhelming. So what's your advice on how one should filter out the noise and stay focused on long-term wealth creation?
Now, definitely it's not easy, right? Because there is so much of information that's coming from all sides. You really feel left out if you keep ignoring all of that. And at the same time, you have to look at some of them and act on it as well. So the key to all of this is to understand the business that you are investing into and understand what are the key drivers for those investments. What are the issues that can impact those businesses from a medium to long term, right? So then you will know the information that's coming in, whether that is relevant or not for that business and whether it's going to change the direction of the company or not. Once you know that it is relevant, then you have to see whether it is material or not in terms of the impact that it will, right? That is also important. It may be a relevant piece of information, but it may not be so material when you're holding the stock for a medium to long term, right? And after all of this, you should also be able to manage your emotions, right? Because we're all driven by greed and fear. And if we cannot manage our emotions, then to segregate the information that's coming in and its impact on the stock or the business also becomes difficult to understand. I would like to add one more point. I think the valuation at which a particular business is trading at is also important because same news will have different level of impact depending on where the valuations are, what are the sentiments surrounding the market at that point of time. The sentiments may not be relevant for a medium to long-term investor. It may be very relevant for a trader. But for an investor, it's always important to understand the relevant information, how material it is, and at what valuation the stock is trading. Because the reaction would be dependent on where the valuations are.
We're talking about long term. So if you had to pick your, let's say, test match players, sectors or themes, you could say that, which, that may not sprint right now, but will steadily sort of compound over the next 5 years, what would that be?
Kshitij, I'll probably pick a couple of sectors and a couple of themes.
Sure.
In India, I would say there are a couple of themes which are going to run for the long term because of our demography, because of the level of income levels that our population is seeing, how it's going to grow, etc. Surrounding that, I would say definitely consumption, healthcare, and manufacturing would be the three themes. Usually, whenever the per capita income has crossed $3,000 in the global context, we are seeing a J-shaped consumption trends coming in. And we are close to that level. In the next couple of years, we should see that. And also government has been rightly focusing on reviving consumption. So that could be one multi-year theme. To cater to that kind of a demand, obviously, manufacturing comes. Almost all segments of our market are at the cusp of seeing a new round of capital expenditure to increase capacities. So manufacturing would be the other theme. The third theme would be healthcare. I think India is clearly underinvested in healthcare. And as our per capita income levels grow, as our lifestyle requires more healthcare support, as our population becomes older, you will keep seeing more healthcare opportunities coming in. Right. So these are the three themes. And in terms of sectors, I would say, given that the valuations are quite reasonable compared to our recent history, Banking and financial services would be one pocket where I would probably bet for a medium to long term. There may not be great support in terms of credit growth or any other parameter in the immediate term. But I think if you are a patient investor, that could be one sector. And along with that, I would choose cement sector. This is a sector which has seen a huge consolidation in terms of capacities being dominated by top 4 or 5 players.
Right.
And in the last 10 years, we have hardly seen price growth in terms of the cement price growth. But despite that, we have seen a good amount of improvement in terms of the operating profit margins, largely led by cost cutting and the operating leverage. I think these trends will get even more strengthened as we look at the near-term capacity addition, which is again going to be dominated by some of these players. So that would be another theme that I would bet on at this point of time.
Absolutely. And I'm sure our viewers would take note of that. And, there's one saying that change is the only constant, and, we evolve over time. Uh, it's a very tricky question, you could say that, but yeah, a very interesting one if in case you want to opt for it. So what's one big investing principle you unlearned over time, and what sort of replaced it? That could be the next golden rule for investors as well.
I think in the initial part of my career, probably I was focused more on how some of the businesses compound over a period of time. And there were many occasions where you see companies delivering good set of numbers, a quarter of a quarter for many years. And then suddenly you witness a kind of a less than anticipated kind of a number from the same company, right? I used to believe that probably it's an aberration. And since it's been such a big compounder in the past, you will continue to see the compounding effects going forward as well. But over a period of time, I've realized that whenever a very good company which has been delivering very strong set of numbers suddenly delivers less than anticipated kind of numbers, then one should actually take notice and dig deeper. I'm not saying that in every company that's going to be the turning point, but there have been cases where that probably was a turning point for that industry or for that business in that cycle.
Absolutely. In fact, when industry leaders face the heat, then yes, it could be a call for caution. The next big, you could say trend or especially the word which is most Googled is the multi-baggers. And yes, now that I have you on the show, I would want to ask that many investors chase multi-baggers. So what's your thumb rule for differentiating between a true long-term compounder and a short-term hype stock?
But I think few of the things should at least be supportive for that business to compound consistently over a period of time. And that's when it becomes a multi-bagger. First, I would say the size of the opportunity itself. It has to be a large opportunity for that business. If it's a limited opportunity, maybe it will do well for a couple of years, couple of quarters, but it will not sustain, which means that you will not get a compounding characteristic in that business. The second one I would say is the competitive advantage of that particular company in that particular industry, right? If there is a sustainable competitive advantage, it could be coming from technology, it could be coming from the business model, it could be coming from various other factors, but there has to be a competitive advantage that should sustain over a period of time. That's what you need to evaluate. We should also see what is the quality of the management, because the same management has to continue delivering results at higher size, higher growth levels as the company compounds its business. So that's also very important. And the capital efficiency of that business, because if a business has to continuously create wealth for shareholders, it has to be really, really efficient business. So it cannot be a capital guzzler, but it has to be an efficient capital user in that sense. I think all of these factors have to be in place. And more importantly or critically, the valuations also have to be in your favor. Because even when all the first 4 factors that I mentioned are positive, if valuations have already discounted all of that or most of that, then we may not really see a kind of a multi-bagger situation. So I think these 4 5 parameters are very, very important.
Now, let me also get your perspective on the asset allocation part, which is also very crucial for building portfolios, or when investors are building portfolios. So, how should sort of retail investors think about asset allocation? What's the balance between equity, debt, and alternates in today's environment? And now that crypto is also picking up, now that I would want your you want to differentiate between crypto and the alternate, but yes, up to you.
If you look at retail investor, there is no one size fits all kind of a solution.
Sure.
Every investor is different in terms of risk tolerance, in terms of the return expectations, all of that. But broadly, I would say most retail investors would be fine if you have a prudent asset allocation between equity, debt, and probably I would add gold and silver in the current context, and also in terms of diversification. They are less correlated with other two. So these should be primary investments. And if you evolve over a period of time as a informed investor, maybe you could look at alternates as well. And I have no view on the cryptos at this point of time, right? So between equity and debt, the way I would probably think of allocating would be to look at what are the expenses that you are likely to encounter over the next 3 years, right? And that is including the emergency requirements on all of that. And that is the portion that should go into something where there is a chance of high degree of capital preservation and also a reasonable returns. I think that portion should go into debt, and anything where you do not require that in the next couple of years, next 3 years, for example, and you are really building it for the long term, you should invest into equities. And gold and silver, I would say maybe about 10 to 15% of your assets at this point of time may make good sense. But obviously, you need to evaluate over a period of time. It may not be as attractive as it is today, given the fact that people are trying to find assets which can hedge their positions against paper currencies or US dollar in particular. So as long as that continues, probably gold and silver will be good bets. And beyond that, you will have to reevaluate.
So when evaluating a company, Harsha, what's one underrated metric or signal that retail investors often overlook, but you find critical?
I would say capital efficiency, because generally people look at the level of profitability or the level of absolute profits that a business does. For example, let's say somebody invests 200 in a business and makes 100 as profit. Right. And somebody else makes 200 as profit. You may feel that the company which is delivering 200 as profit is better or larger in size. So let's look at that. But you should see how much is invested in that particular business. Suppose it is 500, then obviously, even though it is delivering 200, it is delivering on an investment of 500. So I think that's where you need to differentiate between businesses in terms of capital efficiency. Then, of course, I'm in this example, I'm considering all else being equal, assuming business opportunity, the valuations, the people who are running it, all of that. But assuming that all of that is similar, the capital efficiency is something that will differentiate in terms of how well you will be able to grow your wealth for investors.
Absolutely. And with so much of talk around mega trends, it could be AI, it could be EVs, renewables. What's your thumb rule for retail investors to sort of participate without overexposing themselves, to risk?
Don't put all eggs in one basket. Don't chase momentum. Those would be the words that I would say. And also, when some of these mega trends are taking shape, there is a lot of volatility. There is a lot of bombardment of information that's coming from all sides. So you have to be careful and also make sure that you remain invested to a certain extent in your portfolio, but don't over invest into some of these, because finally it's very difficult to visualize some of these trends really from a 10-year, 20-year perspective. So to that extent, start small. And as you get confidence, gradually you can probably build more position in some of those themes. But ideally, in a retail investor's portfolio, not more than 10-15% should be for thematic investments, whether it is a sector, whether it is a theme, etc. Cumulatively, I would not suggest more than 10-15% of one's investments going into some of these themes. Because one, these are high risk investments. Second, these are also not as secular as a diversified equity product. There will be more ups and downs, and that's where you need to limit your investments into this segment.
Absolutely golden words there. And before we sort of wrap up, one final question is, if you had to share one timeless investing thumb rule that investors must remember, what would that be?
Kshitij, if you allow me, I don't have one. I have three. I would say three
Sure,
investment mantras. One, of course, prudent asset allocation. I think nobody should ignore asset allocation, and that should continue irrespective of the market phase, irrespective of how that asset class has done in the past or what is expected to be in the future. It's all dependent on one's risk levels and where that asset allocation needs to be. It needs to be there, and every time you monitor and set it back to that asset allocation. Second, I would say disciplined and regular investments. I mean, Rome was not built in a day, right? So you have to build it slowly and gradually in a disciplined way. So you have to build it over a period of time by making disciplined investments. And third would be long-term focus, especially for equity investors. That long-term focus is very, very important. Otherwise, you may have the thrill of making money in regular intervals in very short time periods. But when you look back at the end of your career, you will see that probably you have made suboptimal returns rather than really creating wealth or compounding your wealth.
Absolutely brilliant as always. Thank you, Harsha, for your time. And I'm sure listeners will walk away with clearer sense of how to tune out the noise and focus on principles that stand the test of time. Until next time, invest wisely and stay disciplined. Thank you so much for your time, Harsha.